Welcome back to the Williams Real Estate Channel. I'm your host, Geordie Williams, and today we are going to unpack our 10 properties in 10-year strategy. So to kick it off, the end goal in mind is to create a passive income. So a passive income is either income that is coming through from rental income and or from releasing equity. You can also release equity out of the portfolio to use as a passive income. So a passive income is an income that is not reliant on you going to a job and earning that income. That income will come any day of the week as you sleep for the rest of your life. So ultimately, to create the passive income to replace your earned income, your day job, this will then allow you to work because you want to work, change industries, be more flexible with what you do as a day job, provide you security, and ultimately to set up your retirement and allow you to step away from the workforce or tailor back how much you actually work day to day. That's the end goal of mine. How we do that is our 10 properties in 10 years. So this is what it more or less looks like. Um, I've built this so personally, I'm at 13 properties in probably 6 or 7 years. So this strategy I've developed is the best way and the most effective way to get to 10 properties within a reasonable time frame. And 10 years is pretty conservative. Even if you're on 80, 100 grand a year, if you're on 150, 200 grand a year, you easily do it within 10 years, even less, depending how aggressive you want to go in terms of lending, in terms of how much you want to push the envelope. If you are okay with going to tier 2 and 3 lenders, 10 in 10 years is very achievable. Um, so provided you stick to certain frameworks of buying the properties for under bank value, under replacement costs, have a strong cash flow, at least 5% yield. The properties have to be located in a region that it has a growing population, in a suburb that will experience gentrification, and a nice balance of both capital growth and cash flow. So to visualize it, depending where we are in terms of the 18-year land cycle, as you would know if you've seen my previous videos, the 18 to 20-year land cycle, the first half of it, Sydney and Melbourne outperform. And then in the second half of the cycle, Brisbane, Perth, Adelaide then outperform. And then the respective regions also perform concurrently. However, the regions I find they typically don't boom and bust or have booms and periods of stagnation like the metro markets do. They more or less just tick over year on year between 5 to 7%. So they are more a conservative play in terms of capital growth. They don't have the significant booms and slowdowns. They tend to just have more consistent growth over the long term, provided you don't go out to say a mining town, Morwell, or up north of Queensland, where the too far regional, where the towns are solely or majority dependent on the mining industry. Those are the towns that are dangerous, and typically banks don't really lend in those areas anyway. Um, so such as Chinchilla, right out central Queensland, um, where there's periods where properties can go up by 3 or 4 times, like within a couple of years when the mines are booming, and then they literally go back to 200 or 300 grand. So they have these massive fluctuations in prices. Um, Banks typically don't lend in mining towns these days. They got burnt last mining boom between 2012 and 2015, where a lot of investors went out there and started buying up. And then after the mining cooled off, the markets collapsed out there. So um, we target regional areas within 2 to 3 hours of a metro city, or the Upper Hunter within 5 hours of Sydney. Um, that have good, strong population growth and have a nice diversified economy. So not just mining, but agriculture, um, health, education, so university. Um, make sure that there is a good, diverse economy and the population is growing, and then they have a good, strong track record of consistent capital growth and not boom bust towns. Um, but yeah, so then it'll be fine. So we start with a unit or a townhouse. So depending where we are in terms of the 18-year land cycle, um, we will either target Sydney, Melbourne, or Brisbane. Sydney, Melbourne, typically the units style, um, two-story walk-ups or three-story walk-ups. We don't like going any bigger than 3 stories. No high-rises, none of that stuff. So um, the low maintenance complexes in Sydney and Melbourne, small complexes. Um, and then in Brisbane, typically it's townhouses up in Brisbane. You can also get units, but typically it's townhouses. Um, so you want to get into a metro market. If you're starting from scratch, you want to get into a metro market first, because ultimately you'll get the capital growth in a metro market. Provide that you get in good timing. You want to get into Sydney and Melbourne in the first half of the cycle, and Brisbane, Perth, Adelaide in the second half of the cycle. They outperform, so you want to make sure that you position yourself before they have that good growth. Um, and then once you're into those two markets, I say probably only two, um, a unit and a townhouse. You don't want to keep going down the route of getting multiple units and townhouses because you can run into cash flow issues because they don't cash flow as well as say a regional house or a block of units. So my suggestion is not to keep going down that route too far, because you'll find that it'll become quite a burden to hold those properties, and then ultimately it might actually make it harder to even hit 10 um, in 10 years. So there are people out there that suggest buy a lot of these, but the reality is that they have a business that supports the shortfall or the negative cash flow, so they're able to keep buying these types of assets because they have a business that's actually propping up the shortfall. So if you're solely building the portfolio and to be self-sufficient, this is, I find, how I've achieved my 13 properties in 6 or 7 years by getting into the market first in a unit or townhouse, only one or two, leverage the growth because you have good growth, but there won't be as good cash flow because you got to pay strata. Leverage the growth out of that into two or three regional houses. So this could be either New South Wales, Queensland, Victoria, large regional hubs, growing population in a suburb that will gentrify. So then you're getting good balance of both the capital growth and cash flow. Regional houses need to be on a large parcel of land. So minimum, I like to target 600 squares because you can put a granny flat on a block with 600 squares, ideally the 7 to 800 plus, because then you can subdivide them. Not straight away, but down the track you can subdivide them, do a battle axe block, or if it's a corner block, it's a lot easier. You can just cut it straight in half and have two street accesses. So then you can build a second dwelling once it stacks up. So say you bought a regional house for 250, 300,000, you hold it for 5 or 6 years, it then doubles in value to 6 or 700,000. Instead of going and buying another house in that same suburb for 6 or 700,000, once the market has moved, you can build the second dwelling for half that cost. So then you're getting it at wholesale. So that's regional houses. Once you then bought the three regionals, you can then leverage the growth out of them to then buy a block of units. This could either be um, a duplex, so two properties, so two units on one title, a triplex, so 3 units on one title, or a 4 pack. This is still, so up to four units, you can still get residential lending. So most banks will be able to lend 20% or 80% loan, so you only need 20% deposit. Once you go more than 4 units on one title, you then tip into commercial lending, which you then need larger deposits, with typically minimum 30%. So I suggest around that three to 4 units once you've built a solid foundation, and then you'll be sitting at 10 properties in 10 years. Once you then you have a solid foundation portfolio. It sets you up to then um, decide whether you want to keep them, let the rent pay off the debt, and then live off the rental income. You may even look to, if you want to keep moving forward and growing further. What I'm doing is I'm now selling down, or not yet, but I'm positioning my 2 units to sell probably next year in around Brisbane and in 2026 when the market tops out. I'm going to sell my 2 townhouses in Brisbane. So I'm going to sell down the original units that I bought early on in my investment journey to then pay down the debt, then reinvest the capital gain. Yes, I'll have to pay capital gains tax, but I'll be able to reinvest the 150, $200,000 as a deposit to buy blocks of units. So I'm selling down one property to buy 3 or 4, a larger asset with 3 or 4 tenancies. So I only say sell down an asset provided you can get a good capital gain out of it. And if you're going to reinvest that into a asset that's going to return you higher, have higher returns, then it makes sense. Because once the market tops out in Brisbane in 2026, 2027, maybe even 2028, I would rather sell the asset down than hold it for a stagnated period of up to maybe 7, 8, 9, 10 years, and then reinvest that money into, say, Melbourne market that's then set to go on its next bull run in the first half of the next cycle in a larger asset than holding the units for the long term. So that's my plan because I'm looking to keep growing, and like my goal is to hit at least 100 rentals. And the only way to do that is by holding property for a certain period of time, then selling down them after a good 7 or 8 or 10 years, and then reinvesting them into larger assets and doing larger deals. So that's a way you can keep moving forward and keep growing, or even look to go commercial. So option one, you could keep the whole portfolio as 10 properties, let the rent pay off the debt, have an unencumbered portfolio. Option two is to keep moving forward by selling down some of the original assets to then reinvest into larger assets. Or option three, if you're looking to buy a family home, you may even want to leverage the growth off the portfolio to buy your family home, or even sell down some assets to reinvest that into a family home. So provides you lots of options. Once you get to 10 properties, it almost becomes a game of chess, and it works, and you can play your game as you feel fit. But ultimately, when you come on board with us, we will build you a chessboard, a chess game set, which then allows you to then play the market and work out what you want to do for your personal situation. So how to do this? So you may be thinking, how the hell do you get in from one property to the next? So these blue lines are essentially recycling equity. So I only purchased or saved up money to purchase my first investment property. I then leveraged the growth out of the first to then buy the second, and then the second to buy the third, and carried on. So you do this by ordering a valuation of your property. You then ideally the value comes in higher than what you purchased it for, and there's fat in the deal. So for example, if the property comes back with a valuation of 600,000 and it has an existing loan of 400,000, you can then apply to top up your loan or refinance your loan to 80% of the new value. they'll then increase your loan, provided you've got the serviceability to afford the extra loan. The banks can increase the loan on the property to 80% of the value. In this case, up to 480,000. They'll increase the loan by that amount and then debit into your account the cash. So it's a cash out refi. Cash out refinance is a typical terminology that banks and mortgage brokers use. So you're cashing out the equity into your account and you're refinancing your loan. So you're adding that extra loan onto the mortgage of that property as security, and then you're using that cash as a deposit and closing costs for your next deal. Um, this is by no means financial advice, but you can also use the equity for discretionary boats, cars, holidays, whatever, provided that you can still cash flow the um, loans, and it's not taxed. Borrowing money, it's tax free because you essentially it's borrowing debt. It's tax free dollars. You don't get taxed on borrowing money. Hence why most of the big property moguls around the world uh, get a lot of flack for paying minimal tax. And the reason for that, for instance, Robert Kiyosaki pays minimal tax, Donald Trump pays minimal tax. Reason for that is they use the equity or they borrow money from the bank against their assets, and they use that money for to fund their lifestyle, to fund their businesses, to fund their life, and it's tax free because it's not it's not an income, it's borrowing debt, but essentially it's numbers on a screen at the end of the day. So it's not financial advice. This is what the big investors do, and I more or less replicate that strategy as well. So you can use the equity um, to both move forward and build your portfolio, but you can also use it discretionary if you like. And then also, if you got the high cash flow from the rents coming through, it services the debt, so you're always in a positive or neutral position, and it's essentially free money. Yeah, I got a formula there to calculate the accessible equity, which essentially is the property value times 80% will give you the loan, 80% loan minus the current loan. So property value times 80% is what they'll lend you up to, minus the existing loan will then give you the accessible equity that you potentially could extract, provided you got the servicing to use for future deals. So this is another way to look at it, is building a property portfolio is like building a campfire. You need to start small and gradually load up the fire so it can continue to burn strongly all night long. So I remember going on school camps and cadet camps at school, and we had to build campfires, and a lot of people or kids back in the day tried to start their fire with going out and getting large logs and too big a piece of timber too early, and then they ended up not getting their fire going. It was smoldering, and then they were blowing it all night. And it was smoking everywhere, and they could never really get their fire going. That is the same concept. What I'm trying to get here is you need to start small with property investment. You don't, if the bank will lend you $1 million, it doesn't necessarily mean that you should go and buy $1 million asset, because it's essentially going and getting a large block of timber or split wood and trying to start a fire with a large block of wood. It's too much debt in one asset, and you need to break it up into smaller pieces to then start with the kindling, so then you can get your fire going. It's self-sufficient. It's burning with the air, fire, flame, and it's burning. And then you slowly load up the fire with so from the kindling to larger pieces of split wood to larger pieces of timber to then ultimately put a big fat log, which would be like a block of units, to let the fire burn all night, and then the fire is self-sufficient. That is the same way I look to build a property portfolio. You don't want to go too big too early, because ultimately you'll smother your fire or you'll hold yourself back in terms of serviceability. So property investment is part art and it's part science. So it's, yes, you need to stick within certain frameworks of buying the property under bank value, have a good strong cash flow in an area that will have a growing population, that will gentrify, and a good balance of cash flow and capital growth. That's the science part. The art is building your campfire and knowing what type of asset is going to allow you to get into your next deal and allow the whole portfolio to maintain itself and not be a burden on yourself, and make sure that it can stay neutral or positive. So then the banks can continue to lend you more money and you can keep growing and building it over time. You don't want to leverage yourself and put $1 million into one unit or two units like most people do and be heavily negative geared and try and build their campfire with too big a logs too early, because they'll smolder, it won't ever burn. You'll be on your hands and knees your whole life blowing it to try and get your fire going. And that's what most people do, is they buy a negative geared property to save a few $1,000 off their tax bill at the end of the year. But ultimately they get stuck in terms of servicing and their finance, and the banks won't lend them more money, and they can't get their fire going, and then they never build a substantial or a sustainable property portfolio, and they get stuck at one or two properties. And then we go through a downturn where it comes on by interest rates going up, and now people are feeling the pinch and they can't even hold on to the property, and they end up letting it go, and they never end up building a portfolio anyway. There's a stat that out there that don't quote me exactly, but it's something like not like 80 or 90% of people who buy an investment property sell up within the first 5 years. And that's probably because they buy a property that is heavily negative geared, because they're going for the tax breaks from negative gearing, and they're sold on the fact that they think it's going to have good capital growth, which is more or less speculation. Um, and they can't end up holding on to it for the long term, and they don't end up actually building any wealth. So if you start small and then allow compound interest to then do its thing, and you can then stay in the game for long term, ultimately forever, and build a portfolio to ultimately give to your kids and hand down to the rest of your family once you are no longer around, that's ultimately going to build your wealth. And you can do that by starting small and gradually growing. You can't build large sustainable portfolios by buying negative geared properties. It's the main reason why most people who get into property investment get stuck at one or two properties. It's like going and taking $1 million loan out to start a business, and after year one, you go back to the bank and you made a 30 grand loss, and asking the bank to lend you an extra 500 grand to pump into your business that's losing money. The banks don't do it. So until they will lend you more money until your income increases to being in positive cash flow. So that's either by the rent increasing or your income increasing. So if your income isn't going to increase for a while, and then it's solely relying on the rental income, so for a negative geared property to convert into a positive geared, that could take 10 plus years if it's heavily negative geared. So that's why we like to start small, have a good strong um, cash buffer and yield, which is at least 5% gross yield, to allow each deal to keep funding themselves and then funding other deals down the line. Just disclaimer, this content is general in nature and is not any personal or general advice. Prior to making any investment decision, you should obtain independent legal, financial, investment, tax advice in relation to buying a property. So I am not a financial advisor. I cannot provide financial advice. This is just general information in nature. This is my story of what I'm doing and how I'm helping clients. If this resonates with you, I'll put my details in the comments below. Hit me up. I operate as a buyer's agent, so I can help you source investment grade property to build a portfolio. 10 properties in 10 years is very achievable based off the strategy I've developed. If you need help, hit us up any day of the week. Happy to chat about your goals and our services further. This is also just a tip of the iceberg of what we go through in a strategy session. Obviously, we go through in more detail the fundamentals of how to build a portfolio, different types of properties, pros and cons of buying a unit, a villa, a townhouse, a house, even different pros and cons or a block of units, or pros and cons of types of materials that a house, buying a weatherboard house versus a brick house, pros and cons, large blocks of land, smaller blocks, closer in town, further out. We go through all that and to ultimately build the strategy that is best suited for yourself, because everyone's different, everyone's got different circumstances, everyone's got different money, capital, risk tolerance, skill set in terms of if you are an IT corporate, have a corporate IT or corporate job, or if you are from a trade background and you are got a more of a construction on hands, willing to roll your sleeves up and do a bit of renovations. We also refine your strategy that way, working out if we want to buy something that needs a bit of that can do a bit of sweat equity uplift, or if you wanted something that's just tenant ready, turnkey. So pros and cons with both, and we tailor the strategy to our clients based off, again, their money they have, capital, skill set, risk tolerance. Anyway, I hope you enjoyed that. As always, this is not financial advice, but I can guarantee one thing: if you don't take action, you will not get anywhere. Till next time, see you then.